Hi, this is John Coumarianos with Mindful Advisory, bringing you the second edition of Driving Returns on Saturday, February 10th, 2024. I would say it's an unseasonably warm but kind of cloudy February day here in northern New Jersey. Um, two interesting things this week to review. One, David Einhorn, a hedge fund manager, gave an interview or appeared on a podcast, the Masters in Business podcast on Bloomberg, run by Barry Ritholtz himself. Ritholtz, the founder of a wealth management or co-founder of a wealth management firm in New York. And Einhorn said to Ritholtz, quote, "I view the markets as fundamentally broken. Passive investors have no opinion about value. They're going to assume everybody else has done the work." And what Einhorn means by that is done the valuation work or the appraisal of the stocks in the index. He's, of course, right. Most people, when they buy an index, just buy it blindly, assuming that over time it will beat the vast majority of active managers. And certainly the academic studies have shown that's true, that usually does happen. And Warren Buffett himself is a defender of indexing for most people, although he himself, of course, does not proceed that way. He is naturally the consummate stock picker. Um, but people have raised concerns about the price of the stocks in the S&P 500 over the past few years, and not only that, but n- not just the price of the stocks, but the um, the part of the index the top 10 holdings occupy. If you buy the index now, every $30 of every $100, or almost $30 of every $100, is going to the top 10 holdings, basically 10 technology darlings, or seven, at least seven, if not 10 technology darlings. We dubbed them the Magnificent Seven last year, and they are also continuing to run this year. But their prices are worrisome. If you look at NVIDIA, which joined this group last year, this is a stock that many people think will benefit dramatically from artificial intelligence, chip maker stock. Um, the stock is trading at 30 times its sales. So if you buy every share of stock, the price of every share of stock of NVIDIA is 30 times the sales per share that the company is generating. Remember, you always have to relate the the stock to the business. Not enough individual investors do that or even think about that. Also, NVIDIA is trading at 80 times or more than 80 times earnings. So every share of stock trades at more than 80 times earnings per share or profits per share. Earnings means profits. Again, we're trying to relate the stock to the business when we quote these metrics, and they're rough metrics. They lack precision in many cases, but they're they can be decent guidelines. And when they get this lofty, they are certainly flashing warning signals. Back in the 1999-2000 period, the famous story in retrospect was that Cisco, the networking technology company, got to very nearly 100 times earnings. The price of a share of stock was nearly 100 times the earnings per share. Now, these companies can grow, but can they grow to justify those kinds of sales and earnings multiples? Time will tell. We at Mindful Advisory did some research. We looked at the top 10 holdings of the S&P 500 and how much of the index they occupied over the last 10 years. It turns out 10 years ago, the top 10 holdings only occupied about 17% of the index. So they very nearly occupy double the amount of the index now that they did 10 years ago. That's a little worrisome. Couple of ways you can mitigate that, one of which is to own the world stock market. So you'll own those top 7 or 10 stocks, but you'll own them in smaller proportion to the rest of your holdings. And we are proceeding that way at Mindful Advisory. We're fans of the global market, owning the global market index as opposed to the S&P 500 right now. Anyway, the second item of note this week, which is related to the first, is white shoe asset management firm GMO, or Grantham Mayo Van Otterloo, co-founded by Jeremy Grantham, a very famous investor, um, wrote something similar to what David Einhorn said. They think in their quarterly letter, Ben Inker, a fund manager there, said the Magnificent Seven are magnificently overpriced or overvalued. He also made the point of how much of the index those top 10 stocks occupy. Inker went on to say that the top 10 stocks in the index at any given time that have done well, almost by definition, over the past 10 years, that's how they've become the top 10, continue to underperform the index over subsequent 10 years. I'm not sure that's the case for the preceding 10-year period. In other words, the stocks that were the top 10 years ago actually beat the index over the last 10 years by my calculation. But Inker's research went back to 1957, I think, and over that full period of time, generally the top 10 stocks subsequently underperformed the index. Time will tell. No one can be sure. The top 10 or the Magnificent Seven are good companies. There's no denying that. Um, but the amount of the S&P 500 they occupy is cause for concern. Anyway, this is John Coumarianos with Mindful Advisory for Driving Returns, signing off. Um, don't hesitate to like the video or click subscribe if you like the work we do, and don't hesitate to contact Mindful Advisory in Northern New Jersey if you have any questions. Thanks very much for watching.